Okay, let's dive straight into this week's source material. We're digging into the weekly investment commentary from the BlackRock Investment Institute, specifically the one from June to 2025.
Right.
The title that really jumped out at us is A Bumpy Ride Upwards for Global Yields.
Hmm.
So our mission today is to unpack what that actually means, why BlackRock's experts think it's happening, and what insights they're pulling from this shift for the markets.
Yes,
Think of it like taking this pretty dense financial analysis and sort of pulling out the core ideas that are most important for you to understand.
absolutely. And this commentary, it gives us a really clear snapshot of the market dynamics and BlackRock's investment views right as of that date.
Right.
What's fascinating here, I think, is how they focus on these big shifts in the fixed income world,
Yeah.
bonds, and then show how those changes ripple out, affects everything else.
Yeah, it really highlights just how interconnected everything is right now.
Exactly. Global markets.
All right, let's start with that big headline then. Global yields are on a bumpy ride upwards. What exactly does that look like, according to the source? And why is it happening?
Well, the commentary highlights that investors are basically demanding more compensation now for the risk, of holding on to bonds for a long time.
Right. Okay. More compensation for long-term risk.
Exactly. And the key concept they keep emphasizing is term premium.
Term premium.
Yeah. It's essentially that extra bit of return investors require for lending money for, say, 10 or 30 years instead of just a few months.
Okay.
And the source points out this premium got incredibly low. I mean, and even negative during the pandemic when rates were near zero.
Wow, negative.
Yeah. Now that's changing. Investors are demanding more term premium, and BlackRock sees this as the main force pulling global yields higher. They kind of view it as a return to past norms, partly, but it's happening in this bumpy way, not smooth at all.
So you should absolutely care about this because bond yields, I mean, they're fundamental. Really.
Totally fundamental.
They influence everything from mortgage rates to how much companies pay to borrow. And they reflect these deeper feelings about the economy and, well, risk.
Precisely.
Okay, let's zoom in on the U.S. then, because the commentary gives some pretty sharp details there. U.S. 10-year Treasury yields, they've jumped quite a bit since April. 50 basis points higher now than their lows then.
And just quickly, a basis point is 0.01%. So 50 basis points, that's 0.5%.
Right.
Which, in the bond world, especially over just a couple of months, that's a really noticeable move.
Definitely a sharp move.
Yeah.
So this raises the question, why the jump? Why is it maybe particularly pronounced or concerning in the U.S., according to BlackRock?
Well, they point to several things that are kind of linked together.
Okay.
They mention policy developments, like the budget bill being considered in Congress. That's putting a new focus on U.S. debt sustainability.
The debt question again.
Exactly. And this is reviving those questions about whether Treasuries still work as that safe haven, the diversifier they used to be.
Right.
BlackRock actually notes they've been flagging this low-term premium in Treasuries for a while now. They expected it to rise.
And why? What's driving that expectation?
Concerns about persistent government deficits, they seem pretty central to it.
The source gives some specific numbers here that are quite, well, eye-opening. They estimate the U.S. deficit to GDP ratio is already in the 5% to 7% range.
Yeah, that's the estimate.
And that proposed budget bill could push it even higher. Plus, they mentioned Moody's recently cutting the U.S. top credit rating. How do these things, the deficit numbers, the downgrade, connect directly to this rising term premium idea?
Okay, so if we connect the dots BlackRock is laying out,
Yeah.
large ongoing deficits mean the government has to issue a lot more debt. Simple as that.
Right, to pay the bill.
To pay the bills. Now, if investors start seeing more risk with that growing debt pile, maybe they worry about inflation eating returns down the line, or maybe big buyers like foreign central banks are less keen, then they demand a higher yield to compensate for that perceived risk. That higher required yield is the rising term premium.
Got it. And the Moody's downgrade.
That's like a formal flag, a signal that, yes, some major players are seeing increased risk. So BlackRock is watching this really closely.
And that explains their position.
Exactly. It's why they maintain their underweight view on long-term U.S. Treasuries. They have less exposure than the benchmark because of these ongoing deficit worries and, well, their expectation that term premium could actually rise even further.
Okay, so a clear story for the U.S. deficits, debt concerns driving yields higher. But is this bumpy ride just happening stateside, or is it global?
No, BlackRock is very clear. It's a global story. This normalizing term premium is pulling up government bond yields across developed markets.
Okay.
But the bumps look different in different places. Take Japan, for instance.
What's happening there?
Their 30-year government bond yields hit a record high in May.
A record high. Wow.
Yeah. And the source links this directly to the Bank of Japan starting to trim its bond purchases. That's a step towards normalizing their super loose policy, right?
Right. Pulling back the stimulus.
Which naturally puts upward pressure on yields. They also highlight a recent 30-year bond auction in Japan that saw the weakest demand in a decade.
Oof. That's telling.
Very telling. It even has their Ministry of Finance thinking about trimming future sales.
And what's particularly striking about Japan, the source mentions their vulnerability.
Yes, absolutely. Their government debt is roughly twice the size of their economy.
Twice.
So even a relatively small rise in borrowing costs means a significantly bigger jump in what the government has to spend just servicing its debt. That's a major bump for them.
Okay. What about Europe and the UK? Similar pressures there.
Yes, similar pressures, though maybe with slightly different flavors or reasons. The UK is also apparently scaling back its issuance of long-term bonds.
Why?
Lower demand, basically, and the higher yields they'd have to offer to attract buyers.
Makes sense. And the euro area.
Yields there have also been trending up. That's partly linked to government spending more, especially on defense and infrastructure projects. But here's where BlackRock offers a really interesting relative view. They actually express a preference for euro area government bonds over U.S. Treasuries right now.
Oh. Why prefer the Eurozone bonds?
Well, a couple of reasons. They see them becoming less correlated to the ups and downs of U.S. Treasuries. That's good for diversification in a portfolio.
Okay, less correlated.
And importantly, they note the European economy is, well, pretty sluggish compared to the U.S., which might give the European Central Bank, the ECB, more breathing room to cut interest rates in the near term than, say, the Fed has.
And rate cuts would generally support bond prices.
Exactly. Keep yields from rising as much, maybe even push them down a bit. So a potential cushion there.
Okay, so we've got this bond market shift happening globally. Term premium returning, local factors like deficits, central banks mixing in.
Yeah.
How does this connect to other markets? Like stocks. The commentary mentions U.S. stocks were up last week, tech doing well after NVIDIA.
Yeah, strong earnings from NVIDIA.
And the S&P 500 is up quite a bit since April, too.
Right. And BlackRock explicitly links their overweight view on U.S. equities, meaning they hold more than the benchmark to the artificial intelligence, the AI mega force.
The AI theme.
Yes. They state that the NVIDIA earnings report specifically reinforced this view for them. They see AI providing real, tangible earnings support right now for some companies, and maybe boosting long-term productivity across the whole economy down the road.
But they acknowledge other headwinds.
Oh, yeah. They acknowledge things like policy uncertainty, supply chain issues. Those could definitely weigh on near-term growth overall. But that AI theme seems to be a really dominant factor in their U.S. equity outlook.
You mentioned policy uncertainty and supply disruptions. The source also talks about tariffs and trade issues. How do those fit in?
Trade is definitely part of that uncertainty picture, according to the commentary.
Okay.
They note stocks initially got a bit of a boost when a U.S. trade court blocked some new tariffs.
Right.
But then that got complicated when an appeals court granted a stay, basically keeping the tariffs in place for now.
So uncertainty continues.
Exactly. And BlackRock is watching closely how these trade disruptions might affect hiring in the U.S. They also point to trade tensions potentially weighing on euro area growth.
Which connects back to the ECB potentially cutting rates.
Precisely. It all connects. Trade tensions, geopolitical fragmentation, they highlight these as major megaforces. Big structural trends changing the economic landscape and hitting markets.
Okay. And what about credit markets? Corporate bonds. Where does BlackRock see opportunities or risks there, given these shifts in government bond yields?
Well, for income and value, they state a preference for shorter-term government bonds over the longer ones.
Shorter duration.
Right. And in credit, specifically corporate bonds, they prefer European credit, both investment grade, the safer stuff, and high yield, the riskier junk bonds, over U.S. credit.
Why Europe again?
Valuations. They see them as more attractive, cheaper in Europe right now.
Oh.
So they're overweight shorter-term investment grade credit, but underweight the longer-term stuff. They mention that with credit spreads being tight.
meaning the extra yield isn't that great compared to government bonds.
Exactly. When spreads are tight like that, they prefer taking their risk exposure in equities from a total portfolio view, rather than stretching for yield in long-term credit.
Got it. Okay, so looking ahead, the commentary lists some key events coming up in the week of June 3rd, right after the report came out.
Yeah.
Euro area inflation, unemployment, the ECB decision, U.S. payrolls. What are they specifically watching for?
They're really focused on that U.S. payroll data, looking for clues on how trade issues might be impacting hiring,
Mm-hmm.
and also how slowing labor force growth might affect wage pressures, which feeds into inflation.
Right. And the ECB decision?
They expect a modest rate cut, that seems baked in,
Yeah.
but they'll be scrutinizing the language, the communication, looking for any signals about potentially deeper cuts down the line if those trade disruptions really start to bite into euro area growth more than expected.
Okay, so let's bring it all back home. For you, listening and trying to make sense of this, what's the overall takeaway from BlackRock's investment views in this commentary?
I'd say the core tactical view right now is pretty clear. Underweight, long-term, developed market government bonds, especially U.S. Treasuries.
Okay, less exposure there.
Yes. They prefer shorter-term bonds and European credit if you're looking for income and relative value.
And equities.
On the equity side, they remain overweight U.S. stocks, heavily influenced by that AI theme we talked about,
Right.
and also overweight Japan, where they cite ongoing corporate reforms as a positive. They're more selective elsewhere, though, noting that those trade tensions are a potential drag, especially on emerging markets in China.
So that wraps up our deep dive into the BlackRock Investment Institute's commentary from June 2nd. We've really seen how rising global bond yields, mostly driven by investors demanding more term premium back, is a significant shift.
Yeah, a big shift.
But it's playing out differently depending on local stuff like government debt, central bank moves, trade policies.
And how these powerful structural forces, the mega forces they call them, like AI and geopolitical fragmentation, are just deeply woven into the whole picture,
Right.
influencing everything from government borrowing costs to where you might find investment opportunities in stocks or credit.
It really just underscores how interconnected and, well, dynamic the whole global financial scene is right now, and how many different things are feeding into that bumpy ride in yields they talked about.
Definitely.
We've unpacked why yields are moving, the specific worries in the U.S. and Japan, why they kind of like European bonds, relatively speaking, and how this all connects to their views on stocks and corporate credit.
And maybe this raises an important question for you to think about as you process all this. Given these fundamental shifts BlackRock outlined, particularly this renewed focus on government debt, on deficit spending as key drivers of bond yields,
Yeah.
how might the traditional role of government bonds, as that safe anchor or diversifier in your portfolio, how might that need to be reevaluated going forward?
That is a lot to think about indeed. We hope this deep dive gave you some really valuable insights straight from the source material.